Good morning, good afternoon, and good evening, depending on where you are. Thank you for joining Mayor Brown's Global Financial Markets Teleconference Series. Today's call is entitled Opportunities and Challenges in Distressed Residential Finance. My name is Lauren Pryor, and I'm a partner in our Financial Services Regulatory Enforcement Practice and co-head of the Financial Institutions M&A Group. I focus on M&A in the financial services industry, including complex stock and asset-based transactions, full equity deals, PE investments, JV arrangements, and more in the residential finance industry. First, one or two housekeeping items. As regular listeners would know, this call is being recorded. We will email an audio link to all participants in case you wish to listen to the teleconference again or forward it to colleagues. In addition, the recording will be available as a podcast. As we will not have a Q&A session, please send any questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This email address can be found on your invitation. Joining me today are Mayor Brown partners Krista Cooley, Eric Edwardson, Christopher Pochon, Susannah Schmid, and Sean Scott. Krista is a partner in our Financial Services Regulatory and Enforcement Practice. She concentrates her practice on matters related to consumer and commercial financial products and services and advises clients on compliance with federal and state laws governing licensing, approvals and practices of financial institutions, mortgage lenders, consumer finance companies, and more. Eric is also a partner in the Financial Services Regulatory and Enforcement Practice. He provides a broad range of transactional and business counseling to clients in the mortgage banking, consumer finance, and related industries, with a specific emphasis on sales of mortgage loans and servicing rights, servicing and subservicing agreements. Christopher is a partner in our M&A group. He focuses on mergers, acquisitions, and divestitures in the mortgage, consumer loan, and auto finance industries. Susannah is a partner in our banking and finance practice. She concentrates her practice on mortgage loan finance transactions and primarily focuses on representing borrowers and lenders in repurchase agreements and warehouse lending transactions. Sean is a partner in our restructuring practice. Sean has extensive experience in complex insolvency matters, including in-court bankruptcy proceedings and out-of-court restructurings and recapitalizations in the residential finance space. With that brief introduction, we will now begin today's discussion. The residential real estate lending industry has whiplash from the past 2 years. We went from a frozen market in March 2020 to the highest volumes and profits noted in the most recent 50 years, powered by low interest rates, a refi boom, and home repurchases at all-time highs outside of urban markets. And now to drastically reduced volumes and compressed margins, decreased inventory, and rising interest rates. Now, volatile markets can be a challenge, but they may also lead to great opportunities. And today, our interdisciplinary team will focus on considerations for different market participants navigating the choppy waters that may be ahead. Sean will first address some opportunities and challenges in restructuring transactions. Sean, over to you.
Thank you, Lauren. As you said, until very recently, the mortgage industry had been riding a home buying and refinancing wave that accelerated when, in response to the COVID-19 pandemic, the Federal Reserve dropped the Fed funds rate to 0 to 0.25%. Now, 18 months later, we're in a very different environment. Last week, the Federal Reserve lifted interest rates by 75 basis points, the third hike this year and the largest since 1994. And with the fastest pace of inflation in over 40 years, it's certainly possible that we'll continue to see aggressive rate hikes by the Fed moving forward. Those, in turn, will have significant consequences on the residential market, both in terms of demand for new homes and for mortgage refinancing. We're also seeing significant changes in the mortgage lending industry as there is a rise in digitization and technology is changing consumer expectations around how mortgage applications are processed, how mortgages are serviced, and the like. This combination of potential macroeconomic headwinds and the disruptive impacts of technological innovation, as you said, creates not only risks, but also opportunities for investors, lenders, and other participants in the sector. So what steps can be taken today or in the near term? In my area of practice, one of our key focuses has been on preparedness, which is one of the reasons we've started this task force to help clients stay ahead of the curve as they navigate these potentially troubled times. Whether it's taking a fresh look at your transaction documents, consulting with your internal or external counsel about potential rights and remedies, refreshing audits or collateral reviews, or assessing potential targets' current liquidity or their debt maturities, there are many steps that can be taken proactively to make sure that you're not caught by surprise. So our first recommendation is to think ahead and try to evaluate what steps you might want to take or need to take in a downside scenario. A second aspect of preparedness is to look to the past. While none of us want to see a return to the challenges of the Great Recession, that began with the bursting of the housing bubble in the 2007 to 2008 period, we can look back to what occurred then, as well as to some more recent stressed or distressed scenarios, to draw some parallels as we think about structuring transactions today. Drawing on such historical and institutional knowledge is one of the cornerstones of this task force. It's particularly important in this sector given that deals in the residential finance space require an interdisciplinary approach. As we all know, there's a heavy licensing and regulatory overlay. Businesses in this sector are very reliant on capital from specialized funding and financing vehicles, such as warehouse lines and repurchase agreements. Because of the specialized nature of the business, replacement or rescue financing may be more difficult to secure than for a typical operating company, and the ultimate universe of buyers may be limited. So all of this places a premium on not waiting till a counterparty or target has hit the wall, so to speak, in terms of its liquidity, before engaging in transactions to preserve going value concern outside of bankruptcy. We are already seeing that with some of our clients that are opportunistically looking to add to their platforms or grow market share and assessing M&A and out-of-court transactions. That said, one of the changes we've seen in the restructuring world over the past couple of decades is that the B word, bankruptcy, has become less of a word seldom to be spoken and has come to be viewed as a potentially valuable weapon in the arsenal to consider when businesses have unsustainable debt loads or have legacy liabilities that are unlikely to be serviceable from future cash flows. We saw even in the Great Recession that mortgage companies, which had lost any viability as originators, were still able to preserve the value of their servicing platforms and other material assets in the context of bankruptcy proceedings. And on the flip side, the bankruptcy code provided comfort for acquirers that they could transact with limited risk that creditors or counterparties of the bankrupt debtors would be able to assert continuing claims. In many cases, this was accomplished through sales under Section 363 of the Bankruptcy Code. The primary advantage of a so-called Section 363 sale is the legal certainty provided by the bankruptcy court order approving the sale. A sale order will generally provide a buyer with comfort that the purchased assets are obtained free and clear of any liens, claims, or encumbrances that could be asserted by creditors who receive appropriate notice of the sale. The buyer generally also will not have to worry about the sale being subsequently attacked as having been a fraudulent conveyance as to the debtor's creditors, or as not having been properly authorized by the debtor's equity holders. Both of these can be material concerns when transacting with a potentially insolvent seller outside a bankruptcy proceeding. Another potential benefit of transacting through a bankruptcy sale or plan process is that valuable executory contracts of the debtor can frequently be assumed and assigned to a buyer, even over the objection of the non-debtor parties to those contracts, so long as certain statutory requirements are satisfied. An executory contract is a term of art in bankruptcy, but simply speaking, it's a contract or agreement where both the debtor and the counterparty have material unperformed obligations. And in this context, one of the interesting aspects of the Bankruptcy Code is that it may override provisions in contracts that by their express terms would otherwise require consent to the assignment or outright prohibit the assignment of the contract without the counterparty's consent. Similarly, the Bankruptcy Code in many instances overrides so-called ipso facto clauses, which are contractual provisions that would allow a non-debtor to terminate a contract or modify a contract upon the occurrence of a bankruptcy or insolvency-related event. This general rule towards free assignability can be an attractive consideration for acquirers where target businesses have valuable contractual rights and licenses. On the other hand, there can be exceptions, including if applicable law excuses a party to the contract from accepting performance from an assignee. What this means in practice is that while many types of contracts can be assigned in bankruptcy, agreements with governmental entities or government-sponsored entities, or licenses that rely on consent from regulators may not be as freely assignable. So acquirers may not be able, in all instances, to simply buy the assets of a business in bankruptcy, but instead may need to be sponsors of a plan of reorganization or consider transacting outside of bankruptcy. These decisions can be complex and outcome determinative. They're structuring questions that require deep subject matter knowledge. Before I turn it over to Chris and others to speak about some of those considerations, I do want to note that for prospective acquirers or plan sponsors, one last significant difference about transactions in bankruptcy is that they are almost never exclusive. Even an acquirer or sponsor that would have insisted on exclusivity outside of bankruptcy typically will be at risk of having the business shopped through additional marketing and a public auction process. For example, when Mayer Brown represented the ultimate purchaser of New Century's servicing platform in 2007, our client had to prevail at auction over 3 competing bids and in a day-long auction. That's not necessarily a bad thing, but the timing and impact of a competitive bid process can be an important factor to consider when assessing whether to do an in-court process versus an out-of-court transaction. So with that, Chris, I will turn the microphone over to you to discuss some thoughts about M&A opportunities in the sector.
Thank you, Sean. So typically, one of the primary considerations in any M&A transaction is speed, and this is especially true for distressed transactions. Buyers and sellers alike will be motivated to sign and close a deal as quickly as possible in order to provide much-needed capital to the distressed entity before it defaults on its obligations to creditors or is forced to petition for bankruptcy. Unfortunately, mortgage M&A transactions are not typically structured for speed. As Krista will explain in a few minutes, the regulatory overlay in the mortgage industry often requires state and federal agency approvals on the buy side or the sell side. While the timing varies depending on the states or agencies involved, the approvals process may be a hindrance to a speedy close. Fortunately, there are some alternatives to a traditional whole company acquisition that a buyer may want to consider to allow for capital infusions prior to the receipt of required regulatory approvals. One alternative is to structure the transaction as convertible debt. In this scenario, the buyer will make a loan to the target company on the date that the purchase agreement is signed. The debt would be convertible to equity upon satisfaction of certain closing conditions, including receipt of regulatory approvals. Closing on the debt conversion will not occur until the target has received all of the required change of control approvals. In between signing and closing the purchase agreement, the target can use the cash from the loan to continue to stay afloat and pay its creditors. Typically, there will be a covenant that the cash from the loan must be used by the target to cover ongoing expenses and service existing debt, rather than making distributions to the target shareholders. Once all of the change of control approvals have been obtained, the transaction closes and the loan automatically converts to equity in the target. This alternative structure is most attractive for minority investments and in circumstances where there may be a shorter timeline to obtain change of control approvals due to the licenses that are held by that particular target. For instance, this may be particularly applicable to business purpose lenders, single-family rental, and bridge loan originators. If, on the other hand, the transaction will require approval in New York or another state that has long regulatory approval lead times, a convertible debt structure might not be the right solution. Note also that if the parties terminate the transaction before closing because they were not able to obtain the required approvals, or for some other reason, the target will be required to repay the loan. The conditions for repayment tend to be highly negotiated in the purchase agreement. Obviously, there is a risk that the target will not have sufficient funds at the time of termination to repay the loan, which is a significant consideration for any buyer. Buyers may negotiate certain restrictive covenants in an attempt to mitigate this risk. Another alternative structure that can be useful in distressed mortgage M&A transactions is for the buyer to acquire an initial minority investment of less than the percentage of equity that will trigger change of control approval based on the licenses that are held by the target. An analysis of the applicable state and federal agency licenses would be necessary in this case. For instance, if an originator target is licensed in all 50 states, industry participants generally take the position that a minority investment should not exceed 9.5% of the equity of the target without obtaining state change of control approvals, subject to specific considerations in each state, and of course subject to the structure of the target as well. The infusion of cash from the minority investment will help keep the target afloat between signing and closing, during which time the parties will apply for any applicable state and federal change of control approvals. Then, once all of the change of control approvals have been obtained, the transaction will close and the buyer will obtain all or a portion of the remaining equity in the target. Though this structure can be useful in providing capital support from signing to closing, there is still a risk that the target will not be able to obtain all of the change of control approvals required in order to close on the desired timeline. In order to account for this risk, the parties will often add a redemption trigger that requires the target to redeem the buyer's initial equity investment if the transaction is terminated for whatever reason prior to closing. So those are some considerations and alternative structures for a distressed mortgage M&A transaction. And now I'm going to hand it over to my colleague, Eric.
Thanks, Chris. I'm here to talk about the impact of the expected environment of economic stress on a particular categories of transactions, servicing and subservicing agreements, and transfers of mortgage servicing rights. While I'll discuss these in terms of traditional residential mortgage servicing, the concepts would apply in other variations of residential finance and finance alternatives. First, let's talk about servicing and subservicing arrangements. These are, of course, agreements for a servicer or subservicer to perform the actual servicing of the loans for a loan owner or servicing rights owner, meaning they would collect and remit payments on the loans, communicate with borrowers, perform loss mitigation, and other loan administration tasks. This may be obvious, but there are risks associated with a servicer or subservicer in financial distress for the normal business reasons you'd expect. If the servicer or subservicer is having trouble making ends meet, its ability to perform may be affected. It may have reduced staffing, for example, so it pays to be vigilant about your counterparties. But there's a unique layer of financial risk related to servicing advances associated with these transactions, however. In most primary servicing agreements, particularly those with Fannie Mae, Freddie Mac, and Ginnie Mae, the servicer has to fund advances. These include advances of principal and interest to the owner if borrowers don't make payments, advances for unpaid real estate taxes and insurance, and advances of costs associated with collections, loss mitigation, and foreclosure. The servicer then has to carry those advances as an account receivable until recovery from a borrower or other source. So the servicer acts a little bit like a provider of financing, funding those amounts for the benefit of the owner of the loan until they can be recovered. If such a servicer loses the financial capability to fund advances and then the payments to the owner, the loan assets themselves may be at risk. On the other hand, a subservicer typically administers the disbursement of these sort of advances, but the funding comes from and is carried as an account receivable by the master servicer or loan owner. In that case, the risk lies more with the subservicer if there's distress on a loan owner. If the master servicer or owner can't fund the advances, then the subservicer may be financially exposed. Of course, a natural reaction to that may be to say, well, if the master servicer or owner can't fund the advances, the subservicer shouldn't make them. But the reality is more complicated. In many cases, a subservicer can't simply abandon its work of performance of servicing. For example, the subservicer is required by law to engage in loss mitigation efforts. While the discussion to this point has been about financial distress generally, we should talk about bankruptcy issues specifically. Note that I'm focused on bankruptcy here, but chartered banks are subject to FDIC receivership process, not bankruptcy. We don't have enough time to explore the different implications of the receivership process, but just keep in mind that somewhat different principles may apply where chartered banks are involved. Sean mentioned requirements and rights related to executory contracts. Servicing and subservicing agreements generally are executory contracts and subject to those rights and responsibilities. So if one of the parties to a servicing or subservicing agreement, whether it's the owner, a master servicer, or a subservicer, goes into bankruptcy, the following rules would generally apply. First, the non-bankrupt party can't terminate the agreement, notwithstanding the rights to terminate. So even though your attorneys may have put some wonderful provisions in there saying that the agreement would terminate, that will not be the case. So even though there are understandable concerns about the bankrupt party, the non-bankrupt party may have to live with the relationship, at least for an initial period of time until legal proceedings and bankruptcy get rolling. One big exception to this rule, however, Ginnie Mae is not bound by restrictions on termination or automatic stay in bankruptcy. It can terminate the agreements with master servicers and therefore effectively the servicing rights themselves, regardless of these limits. Second, the bankruptcy estate can assign the agreement, as Sean mentioned, notwithstanding limits on assignments that may exist in the agreement. The agreement is an asset of the estate that may have realizable value that helps satisfy creditors. That's especially true for servicers that own the servicing rights. There's, of course, a market for the servicing rights and significant value to those assets. In a liquidation, those agreements will almost certainly be assigned, subject to some of the limits that Sean mentioned. Third, the bankruptcy estate also has the option of rejecting the agreement, in other words, terminating it. So if a servicer or sub-servicer goes bankrupt, the owner may soon find it has to arrange for a replacement servicer. Or on the other hand, if an owner goes bankrupt, the servicer may soon take a hit to its business when its agreement and its expected revenue from it is rejected. In my remaining time, I just want to briefly talk about transactions and mortgage servicing rights, or MSRs. These are, of course, the assets associated with being the master servicer for an owner of the loan. Most of these, again, are Fannie Mae, Freddie Mac, and Ginnie Mae servicing rights, but there are also servicing rights associated with private securitization trusts and whole loan owners. So I'm sure everybody listening knows the value of servicing rights has jumped significantly over the past few months. That's because there's a counter-cyclical element to this asset. With the interest rates rising for borrowers, prepayments have slowed and the loans have a longer life expectancy. And essentially that the servicing fees will last over a longer period of time, raises the present value of those servicing rights. That's created some interesting dynamics in the market. Most obviously so far, originators that have been holding on to MSRs, generally speaking, for the last couple of years, and maybe dealing with some reductions in origination revenue at this point, are coming to market with bulk sales of these servicing rights. Or in some cases, to Chris's area of expertise, they may be packaging those in the sale of a company as an incentive to sell a company that they may no longer want to run. Of course, buyers of the servicing rights need to evaluate a seller's economic health. Servicing sales typically come with a long tail of remedies. There are invariably problems with some loans, and the buyer has the right to ask for indemnification for related losses or repurchase of the loans as servicing right. The buyer therefore needs to consider whether a seller in a given case will be there and able to fulfill those obligations when needed. These deals also similarly come with a long tail of obligations related to the physical transfer process, including particularly for transfers of loan documents and data. Most MSR deals, a portion of the purchase price is held back to ensure the performance of transfer obligations. That may be helpful, but the best thing to have is an available, capable, and interested seller to assist with post-transfer issues. Tying back to bankruptcy again, Sean mentioned fraudulent conveyance issues, making the possibility that somebody would argue that to set aside a transaction that might have occurred shortly before the declaration of bankruptcy. While the revocation of a transaction into such an argument should result in a return of purchase price paid, there would be considerable sunk costs associated with that process, and folks would be well advised to pay close attention to valuation of transactions for sellers who may be in distress. Finally, one last word on financing of servicing rights and investments in excess servicing. We here at Mayer Brown spend hours discussing the specialized nature of these arrangements with our clients, and it's well beyond the time we have today. Just note these are complicated transactions with unusual elements, especially related to the terms of the relationships with Fannie Mae, Freddie Mac, and Ginnie Mae, which may heavily influence the bankruptcy process or dealing with distressed companies. Speaking of financing, I'll now turn the call over to you, Susannah.
Thank you, Eric. Hello to the listeners out there. As my practice focuses on mortgage loan and residential property warehouse financing and financing of mortgage-adjacent products like servicing advances and servicing rights, I will discuss general considerations in the warehouse lending space in this volatile market. With respect to opportunities in distressed lending in the resi space, there are three main levers worth considering in today's environment. First, warehouse borrower distress. Second, warehouse lender distress. And third, mortgagor or property distress. Common to all of these levers is that the shrewdest strategy for all deal parties in today's volatile markets is to have intimate familiarity with the deal terms before there is distress as that familiarity will enable a fast reaction time, which is necessary to navigate any choppy waters that may arise. First, in this market, warehouse borrower distress will likely come in the form of a breached financial covenant in one or multiple deals that would likely trigger cross defaults in other deals, giving rise to the possibility of foreclosure on the assets securing the loan and the parade of horribles that could result from these foreclosures. From a borrower's perspective, it's important now more than ever to make sure, as a borrower, you have a strong working relationship and good communication flow with your lenders. As a borrower, it's key to understand whether there has been or could be an assignment or participation of your loan and to understand what consent rights the primary lender has retained. If an assignment or participation has been made, as a borrower, it may be more difficult to navigate your own choppy waters should they arise with an unknown assignee or lenders or participants that may not have the same level of familiarity and comfort with your business. In addition, it's important to have an acute understanding of what consents would be needed to waive potential breaches and what grace periods may exist across your debt platforms. Said differently, now is an ideal time to inventory and diligence the default mechanics in your deals so that you as a borrower are prepared to act quickly should a distress scenario arise. If you have a grace period, being able to react within that time may be the difference between solving the issue with an amendment or the occurrence of an event of default with the cross-default triggers. If a breach is reasonably likely to be on the horizon, the best way to get in front of this is to try to work through and renegotiate financial covenants as soon as there is an imminent likelihood of an impending breach. However, sometimes the inevitable breach will happen. From both a lender and borrower perspective, the key to navigating the uncertainty is consistent communication with all lenders and, if possible, working through forbearance agreements as quickly as possible. Second, although perhaps of a lesser concern, warehouse lenders may also face financial uncertainty in this climate. Many mortgage loan warehouse facilities take the form of a repurchase agreement, which is a sale of assets for bankruptcy and commercial law purposes, but a loan for tax and accounting purposes. The seller or borrower will sell assets likely for a purchase price that is less than par with the obligation to buy back the assets at the same price at a date certain. These agreements also typically permit the initial lender or buyer to freely sell the assets to a second lender or buyer. If the first-tier buyer goes bankrupt, the second-tier buyer can assert ownership of the assets, meaning that the original seller would not be able to assert their rights to the assets with respect to the second-tier lender or buyer, despite the first-tier seller's right to buy back from the first-tier lender or buyer. As the seller likely sold the assets at a discount, if they are unable to reobtain the assets, they would have lost that haircut amount with the seller's ability to recover, typically resting on the seller's ability to assert a deficiency judgment against the first-tier lender's estate. Finally, the market volatility is also likely to result in an increase in mortgagor distress. Fortunately, with the rise in property values that has accompanied the pandemic, this may also ameliorate some of the likelihood of property foreclosures that we saw in the last crisis, as mortgagors can sell their homes to avoid impending foreclosures. In addition to the aforementioned issues, understanding how non-performing assets can trigger liabilities in deals, whether those deals be warehouse loans, asset sales, or securitization, is also a key to ensuring fast reaction time should assets go into distress, and in particular with respect to securitization, understanding rights and obligations and interplay between investors, trustees, and sponsors enables fast reaction times as problems may arise. In all of these aforementioned distress scenarios, entities have tended to fare better when they understood the rights of the counterparties, the details of their contracts, and were prepared in advance for how to address different situations. Having counsel that can provide an integrated approach to swiftly identify the interplay between contracts, bankruptcy law, and regulatory issues is of utmost importance to staying ahead of what may be a rocky road ahead. And with that, I turn it over to Krista Cooley to discuss certain regulatory considerations to be mindful of.
Thank you, Susannah. So as you have heard from all of my task force colleagues who have been discussing opportunities and challenges that are present in connection with distressed residential finance, one of the unique challenges associated with navigating these opportunities on both sides is that the participants in the residential mortgage industry are highly regulated entities who are subject to extensive licensing, registration, reporting, and practice requirements that impact the options available and the requirements that apply to each of the options that are being considered. If the entities hold federal approvals, similar requirements that are specific to those regulators may also apply. So in these last few minutes, I want to briefly touch on how these state and federal licensing and regulatory requirements work, how the transfer of control of a licensed or approved entity is regulated, and give some examples of the types of reporting obligations that may arise in connection with distressed residential assets. So as many of you know, licensees are required across the state laws to originate residential mortgage loans, and many states also require a license or registration to service residential mortgage loans. A significant number of states also require a license to purchase, acquire, or hold a residential mortgage loan, even if the purchaser or holder does not hold the underlying mortgage servicing rights, or as Eric mentioned earlier, often referred to as MSRs, or whether that entity engages in actual servicing activities like the collection and remittance of payments. And there are even certain states that require a license just to hold those MSRs, even if those servicing activities are outsourced to a third-party mortgage loan servicer. So just determining based on the activities that are being considered, if being either conducted by the entity that's in distress or being considered to be moved to another entity is just an important threshold consideration that requires the review of multiple jurisdictional questions at the state level. In order to originate, service, or hold residential mortgage assets, an entity has to meet each one of those states' requirements, which can include, among other things, submitting audited financial statements, having policies and procedures in place regarding the licensable activities, having in-state offices, having designated qualified individuals who have the right industry experience to meet each of the state's specific criteria. And also, and I think this one's really important as you're thinking about assets in distress, the officers and directors are often required to complete personal disclosures, which may include personal financial statements and fingerprinting, among other items, that can be burdensome, intrusive, and time-consuming. And depending on the jurisdiction, those personal disclosures may be required from individuals not just at the officer and director level, but also those who hold more than the requisite threshold of indirect ownership interests of the licensee, or even of an entity that's seeking to acquire an interest in the licensee. And these licensed entities are going to be subject to certain additional requirements, including business practice requirements like maintaining books and records, maintaining the requisite net worth, financial quarterly and annual report requirements, which could become very important, as we'll talk about briefly in a minute, in this distress space, and also renewing licenses annually. And of course, the licensed entity will be subject to ongoing regulatory supervision, examination, and oversight by each of the state regulators. Similar requirements are going to apply at the federal level if the entity's residential mortgage activities involve loans that are sold to or securitized by the government-sponsored entities, or loans in Ginnie Mae pools, including FHA-insured loans, VA or RHS guaranteed loans, all of which have their own similar approval and ongoing practice requirements. So it is very important to understand these licensing and regulatory requirements, both in terms of evaluating an entity that may be in distress, as well as any potential movement of assets, activities, or personnel associated with residential mortgage loan activities, because they may trigger licensing or compliance requirements. To that end, it's important to note that generally, these licenses and approvals are not transferable from one entity to another. And the changes to ownership, control, and/or executive leadership of these regulated entities can trigger what is commonly referred to, and as Chris mentioned before, a change of control analysis as it relates to Ginnie Mae, the GSEs, and certain state residential mortgage finance laws. Depending on the jurisdiction, even acquisition of a non-voting stock or non-voting equity interest investment could be subject to these requirements, which, as I mentioned earlier, could require personal disclosures of direct or ultimate indirect owners of the licensee. And the determination of whether the change of control provisions apply can be based on the form of organization of the licensee or the entities in the chain of ownership, among other things. Even debt structures can warrant change of control analysis depending on the extent of the debt holder's ability to exercise control over or directly manage the policies of the licensee. Also, if an entity's existing name is going to change as a result of a restructuring or a purchase, that may also require regulatory filings or approvals. And there are several jurisdictions who require only advance notice of such changes of control. But there are some important jurisdictions, including New York and certain of the federal agencies, that require prior approval, which can take additional time to secure. And as Chris mentioned earlier in his comments, timing is incredibly critical in connection with distressed assets. So appreciating the required state and federal notice and approval process and whether any new licenses would be required depending on the transaction and how long that process would take is really a key consideration as you move through the analysis of some of these opportunities in the space. And I will also note that depending on how the proposed investment restructuring will be contemplated, the parties may need to consider whether the GSE or Ginnie Mae cross-default provisions will apply. And that's going to be dependent, as much of this is, on the circumstances in each transaction. So in addition to the licensing and approval considerations, as I noted earlier, participants in residential mortgage loan activities are subject to ongoing requirements at the state and federal level. And if they're holding federal approvals, as I said, at the federal level, to maintain the sufficient net worth and liquidity to meet the various regulatory requirements, and also to report significant adverse changes to the business or the net worth and liquidity requirements. And the agencies, for the most part, require compliance with these reporting requirements with strict time limits that are set forth in each one of the guidelines. Now, it gets complicated because the calculation of net worth and liquidity, as well as precisely what must be reported and when, will vary across the regulators, which adds to the complication. So by way of example, Fannie Mae requires seller servicers to meet minimum financial requirements, and the failure to do so can result in breach of the seller servicer's contract with Fannie Mae. And any significant changes in financial position or management personnel need to be reported, which can be part of that change of control reporting obligation, but also just need to be reported in the normal course. So you really have to be conscious of these reporting requirements as you're thinking through various options as things are changing quickly, particularly in connection with net worth and liquidity. FHA has similar requirements regarding net worth and liquidity. If they fall below minimum requirements, very timely reporting is required, and if operating losses of a certain percentage greater than net worth occur, there are also quarterly reporting requirements with corrective action plans that need to be submitted. One final thing I will note is that, not surprisingly, both state and federal regulators have an incredible amount of authority to impose penalties for noncompliance with any of these licensing, change in control, practice, provisions, or reporting requirements. Penalties can range anywhere from civil money penalties, cease and desist orders, up to termination of the authority to engage in the relevant regulated activities, which among others, and that level of termination or breach of contract obviously comes into play very importantly when you're talking about opportunities to invest in or restructure assets that are in the types of distress that my colleagues have talked about earlier. And I will also note that in the last financial crisis, one of the things we saw regulators pursue was personal liability for certain control persons who, for example, continued to originate residential mortgage loans when the individuals had knowledge that warehouse lines had been pooled, and for various reasons, funds wouldn't be available in order to lend. And those types of personal liability can take the form of things like debarment from future participation in residential mortgage activities, all depending on the jurisdiction and the specific requirements that are applicable. So I went really quickly, and I know we've taken up a lot of your time this afternoon, but these comments, both mine and those of my task force colleagues, really do just scratch the surface of the types of business, contractual, regulatory, and licensing questions and considerations that arise in this environment. I hope that I've demonstrated how critical it is to consider the types of licensing and regulatory issues that can apply in this very uniquely regulated space, not just at the end, but really throughout a period of distress, to ensure compliance and, if necessary, regulatory engagement in any transaction or restructuring that's being contemplated. And that is definitely a key element of the Mayor Brown Task Force in this space. And with that, I will turn it back over to Lauren.
Thanks, Krista. Yeah, a few quick takeaways from our call. First, call on your advisors early and often. The market and transactions may move quickly in this environment. You'll want to be prepared with the right team to approach challenges and take advantage of opportunities. As Krista mentioned, we recently formed the Mayor Brown Task Force for this purpose, and we're really uniquely positioned to handle transactions in this space with the right mix of skill sets and substantive expertise across regulatory, compliance, restructuring, M&A, licensing, servicing, and finance. So a few brief reminders here at the end. You will receive an email with a link to the recording of today's call. The recording will be also available as a podcast. Lastly, as mentioned before, if you have any questions related to today's content, please email us to gfm@mayorbrown.com. Thank you for your participation. Thank you for listening. You may all now disconnect.